Okay, we find ourselves now in lecture 5 of our winter series. This is the last series for the year before the next lecture iteration of the series begins. This is a fun period. This is when we're going to do some experimental subjects and some crazy things. So I guess up to last lecture, it was all pretty standard, and those students who have been with us the year before, they would recognize a lot of this, although it's maybe cast in a slightly slicker format here. But now things are changing, and now we're broaching very new subjects. And the subject I want to talk today came out of a close cooperation we have with Rabobank, where we have a nice project, a very interesting project indeed, where we're dealing with the banking business. Let me see if I can sort this thing out. So, the banking business, and we're making bone graphs, we're doing our usual thing, but the banking business, like most businesses, is rather complicating, involving several variables that are related to each other. So we've been working hard in fully understanding that with a group who is working on that. That is Emil and Britt, who is not with us today. And from Rabobank, we have a team consisting of Pieter van Zwol and Jeroen Kleine, and there's a new kid on the block there, Bruno. I actually don't know his last name.
Peter knows. He's here.
Ja, de Klein, geloof ik. Huh? Huh?
Yeah, Bruno de Klein, that's right.
Yeah. So I also would like to, we have with us Peter from Rabobank, and so I'd like to also introduce him. We've been talking to him a lot, but for some of you, it will be the first time you see him. So we're very fortunate that he is joining us for this lecture. So what I want to do is a lot of what we've done is talking about regular economic production, whether it's good, whether it's oil, like some of us who are working with Shell and others. And I'm going to start with that because there's a lot of parallels between that and the banking business. So before we launch into the banking business, which is somehow hides a little bit of the complexity where what's exactly going on, because the goods that they're trading have the same units as the prices. They're just in the money business. And then a lot of these units cancel, and it's sometimes hard to unravel exactly what are flows and what are stocks and what are prices and what are the forces, you know? And if you take an engineering approach, you have no choice. You have to unravel that, otherwise your model is not working. Now, we've been talking about analytical mechanics. That's the overall name for both Lagrangian and Hamiltonian mechanics. And I've been advertising how great it is to I have to still get used to this new, how great it is to generalize what we're looking for from the Newtonian perspective. And that's why this analytical mechanics is in here, because it's another way of kind of, flexing our muscles and fully understand what the analytical mechanics is doing. So with all of that, I'm going to, I can just use the clicker? Doesn't seem to, it just goes to say, Yeah. Can you give me the, We're dealing here with a brand new connection where it will allow me to save some of these notes that I'm making. So please bear with us. So we'll have to somehow get this on one page. The problem is, yeah, that's it. So what I'm going to do is I'm going to start with regular production theory. And in production theory, it's not just about the stuff you produce. Those are the products, but also the capital equipment that you use to produce them. So there is at least two types of goods that are available. The time immemorial, or the time memorial example of this is land. Land is the original form of capital. I think it exists from 10,000 before Christ. That land became a form of capital, that people started settling down and having farms, and land became property. So you could own it, you could have your stock of land, all right? And then this land was not just used for looking at or walking around on. No, this land was used for growing crops. So you had two different kinds of assets. One is the land, which is what I'm going to call this Q0, and I'm going to call it real capital. By real, we mean real physical capital. And there are products that I'm going to call Q sub I, where I runs from 1 to whatever it is. So you can have barley, you can have wheat, you can have this, and you can have that. Okay? So we have a state space or a configuration space that is at least two-dimensional. All right? So there's the capital dimension. This is where the land is. There's the Q1 here, what the yield is on the land, what the crop is that you're actually growing, okay? And in the capitalism, as the word said, that kind of came up at the end of the Middle Ages. Then there was another form of capital that came around, and that was a ship to go to the Orient and trade with, all right? So this real capital have got another dimension. We're not going to deal with that ourselves, but in this lecture, we'll just assume one for convenience. But that's why it's called capital. And then with the Industrial Revolution, another piece of capital came around, which was labor. And you can invent as much as you can, as you want, really. I mean, people are presenting now knowledge is a form of capital and that kind of stuff. Okay? So the point is, you can always, and economists do this, they separate the capital goods from the consumer goods, okay? And the consumer goods, they typically only look at the flow, and for the capital goods, or the factors of production, as they may call it, they only look at the stock. And they don't kind of look at, it's a separate theory, the theory of investment and all of that, okay? So if you look at your Lagrangian, in one of those variables, only the Q dot is going to, the velocity will appear, and the other one, the capital one, only the stock would appear. And the economists don't really think of inventory stocks. Neither do they think of you buying more equipment, all right, or selling it. Okay? But we'll have a configuration space that is this two-dimensional. At the minimum, you can make different products. You can grow, I don't know, some other crop, tomatoes. Huh? And both of them will have their velocity. And in the case, and those are the quantities demanded. And there are two types of demand here. Demand for capital, which is investment. Okay, that's the name for it. Real investment, that is. And then demand for the products, which is just your regular type of demand, okay, for the apples that you're growing on this land. All right, so here is our total space. It consists out of a base space or a configuration space where you have your capital and then your inventories of the products that you're making. Huh? And at any point, you can have your investments, which is the velocity in the capital direction. That's your demand for investment. So your accretion of capital, or capital accumulation, sometimes it's called capital accumulation rate. This is the accumulation of your inventory of whatever, wheat, barley, whatever product you have. All right? So we're sitting in a four-dimensional space, a two-dimensional base space, and a two-dimensional tangent space. Okay, so that's what's apparent from this picture. All right? Now, this is just irregular flows, irregular stocks, and all the stuff that you're used to. what people do in practice, they don't use these variables, okay? What they'll do is go to a sort of a rotational analog, all right? And this is done in the following steps. So let me clarify what goes on here. This will be useful when we deal with the banking analog, all right? So if you have a certain crop yield, what you do is you don't want to say I'm making 50 bushels of something, you know? What you would do to look at what you're really producing is divide by the number of hectares you have or acres, okay? So you're producing 50 bushels per acre, and then you will specify later how many acres you have, all right? So if you're making widgets, you make making so many widgets per machine. And then you will look at the number of machines. So here are the acres of land, and this is it. So what you really do is you'll take this velocity V1 here, now how do you get this? Yeah. Oh, yeah, okay. Huh? So let me do this. So what you'll do is if you're at this point, so this is the amount of capital you have, and these are the products you have in inventory, you will take your production, and you will look at this point, how much land do I have, how many acres do I have, and you will divide the two, right? So you'll say, all right, I'm going to calculate some kind of new velocity. Huh? It's a little cumbersome, this thing, huh? And it's just this velocity, V1, divided by number of angles, the number of acres I have, the capital I have. All right? So this will be in bushels per acre per year, since this was the amount of bushels per year you made, right? So this here is this distance. So it's very much like what we would call an angle, right? So you take some velocity vector and you'll look at the arm. In this case, the arm is just a projection down, and then you look at the angle. So if this thing were here, it will be literally the regular angle, okay? Is that clear? So that's what I did here. And that has a name that's called the yield, right? So the yield is so many bushels per acre, all right? And it's in, these are the units, okay? Then you can go to a new set of variables that consist of, so if you integrate that out, you will get the total yield over the period, right? And that would be this theta. So this is the period. Huh? All right. And then your velocity will just be the time derivative of this thing. So, okay. Easy peasy. And if you integrate that over some period, you're going to get back your variable theta. So you have a new, instead of this product, you're just counting the total yield you've received over the period, all right? And sometimes they'll just let Q0 kind of run along here. You count acres and the yield. But often economists go a step further and also like make this one sort of dimensionless, okay? And what they'll do is they'll divide this vector also by Q0. And that will be the amount of capital you accumulated per unit of time divided by what you have. So it's your percentage increase in capital, okay? These are the same units, and then you get time left over. And this is what they would call the capital accumulation. And they leave out the word rate, but we can call it the capital accumulation rate, okay? So it's also a sort of an angle. It's a little bit weird angle. It's sometimes called the hyperbolic angle, but That's not so important for the present discussion. The point is, a regular angle works orthogonally on the arm, right? That's why you get the little I in your e to the I, whatever, huh? Because that, huh? So if you integrate it out, you know, with complex numbers, you get this little I here, huh? Telling it's orthogonal. And you can also expand in line with it, and you'll get a different group of action. But it's still an angle, or sort of an angle, okay? It's a percentage increase. Right? So we could like switch to both these variables. We'll have a new space, and then at every point we'll have a tangent space, and we can just span it by that. Of course, there's a point missing, the Q, when the capital is 0, you can't divide by 0, so this one has got 1 point missing. But nevertheless, if you take care of that, you can go in between either description, okay? You can either look at the actual amounts, or you can look at these relative amounts, the yield and the accumulation rate. Right? Or you can mix and match only the yield and just look at the capital. You have all these possibilities, but the point I'm trying to make here is this is the same problem. It's the same situation that you're describing. You're just using different variables, okay? Now, this is really clear if you have land and bushels. The trick is, what we're going to do later is replace these things by different dollar streams or money streams, and then everything starts canceling, and it will look much simpler, but the same mechanism is going on, and you'll get all kinds of cash flows and percentages. But the thing is that conceptually, you have to keep this picture in your mind, okay? So let's move on. So, sorry? Oh, here we go. So just to reiterate, let's go back to this picture here. And I've been telling you all about differential geometry. We'll just translate that differential geometric language. Last lecture, I also told you about symplectic geometry, what it has to do with the balance sheet. I want to quickly mention how this would show up and how this happens in the real world. And then we can go on. All right? Huh? So let's look at that. What is Q? Well, big Q, that was our covariant space. That was the space paired by our products and our capital, right? So there it is, Q. It's going to be like R2 or Rn plus 1 in this case. But it could be any manifold, really. It's n plus 1 dimension. 1 dimension for your capital and n dimensions for all the products, right? One product, it will be 2-dimensional. Right? Now, at every capital and inventory stock level, there could be some demands for new capital, additional capital, or demand for additional inventory stock or supply, right? And these are rates. So these go into this rate calculation. This is the tangent space, right? So here's the picture that we're so familiar with. Our capital stock, our products, our crop, and you're going like this, and at any point here, you can have this tangent vector, right? And this vector lives in the tangent space of this point Q, right? And this is the point Q, and that point lives in the base space, all right? So the entire state space will depend on the specification of how much capital you have and how much inventory you have. And in addition, what the current level of the quantities demanded is. All right? Then you have position and velocity, and you got the whole thing fully specified. Okay? This is how we translate this to state space. You know, there's a writer that I love. He's doing a lot of differential geometry, William Burke, and he says the trick, as always, at the beginning is to get into the right space. So I just want to show this is the right space. You got to get in the right state space, because if you know the right state space, there's stuff going on that you're never going to see, or you've overdimensioned the thing, and there is stuff that you're keeping track of that will never happen and can't ever happen, and you'll never be able to observe anyway, right? So the trick is to get in the right space. So this space is 4-dimensional, the state space, okay? Now, what do we do then? Remember our last lecture? At that point, we start looking at the tautological one form that gives you our expenditures. And another one we have now for the inventory, right? Huh? So we have two expenditures. We have capital expenditures and we have expenditures on inventory, where typically these will be also sales, right? But when we produce these things, we have inventories, right? So we multiply by the price, whatever that is. We haven't modeled that yet, but think about it. And then you can just book these things in your balance sheet. Well, this is some general ledger, and here's a balance sheet. Huh? So these things, they go into your subsidiary ledgers. These Q's and the Q, not these Q's go in your subsidiary ledger. You have an inventory ledger. You have a capital ledger where you keep track of the physical items. And then you have your balance sheet, and you start keeping track of these values here, right? These expenditures. And here I took one from the Grand Corporation. I think it's made up. But anyway, I just snagged it from the internet. And here you can see these accounts, right? So they have, this is sometimes called cost accounting. They have here the different inventory accounts. So they have Q1, Q2, Q3, another Q here, office supplies, Q4. And then here, they'll have one account for the capital. They call that PPE, yeah? Property, plant, and equipment. Okay? And I hear some intangible assets. We won't look at this. Huh? There's some goodwill. So you see, and here's just some accounts receivable. That's just stuff they get from their customers. So you see a large part of this balance sheet is just taken care of with this picture, right? There is other items on this balance sheet. This is just to show you that if I set it up like this, if I set up the symplectic geometry like this, I set up the tautological one forms, etc., that keep track of the money, right? I can see what goes in here. Now, the one question you have, what is the price they used here to value these? And that is always a discussion in accounting, right? Are they going to use the book value or market value or some assessed value or something, right? They don't really know this, right? And there are standards to say when you should use what, but there is always a discussion. In economic engineering, these are your personal values, right? So they are the systems, yeah? So the system is the reservation prices. This is the price or the internal accounting price, is sometimes called. In Nederlands, interne verrekeningsprijs. So the system itself values this item this much, right? It's your value, right? Not something that you might have bought it for, unless you bought it exactly at the price you were willing to pay, all right? So don't forget that. So an accountant may use something else, but you should, in your mind, fill in that these are your reservation prices if you are the system, or whatever the system's the reservation prices are, all right? So if this is the producer of these goods, then he or she has his own reservation price, and it may be different than what a customer has. And then when you have a customer, well, he won't have this capital I mentioned, right? Okay? The point is, we're seeing how our whole geometry kind of fits in here, how our separation of capital and good products fits in the kind of way, the accountants would separate these two. And we have these other things like yield. An accountant will actually not think of the yield, won't analyze it in this way, most likely. They could, but they don't. All right? But that's how a businessman might think of it, like, okay, what are yields this year, etc. All right? We will be able to set up the accounting for the yields too. Okay? So this is clear, right? I want this to be clear because then I can move on. So I guess the empty looks all mean it's so clear that there is nothing to ask. Okay? So what I'm going to do now is make the switch to banking. Okay? Now, the idea that is going to be put down here is that banking is a business like any other business. like the production business. They produce what? Well, they produce interest, okay? All right, what do they use to produce interest? Well, they have some amount of capital that you have to put at work, all right? What kind of capital is this? This is not real capital. No, this is financial capital. And it's also sometimes called the principal. So how does this work? If you go to the bank and you want to buy a house, you'll need a mortgage, right? Now, in order to, when you make this mortgage agreement, there's going to be two types of money, that are going to be of interest for you. First is the amount of money for the loan itself. So if your house costs 500,000 euros, you're going to make a loan for 500,000 euros, and you'll have to repay those 500,000 euros, okay? And the bank will have to keep track of your payments, and you do too, all right? But there's more. The loan is not interest-free. So there's another flow of money, it's called the interest. That's separate from the repayments of the loan, okay? And the interest, that's the product what the bank is really interested in selling to you, right? At what rate of interest they can give you their capital, all right? And they may turn around and get capital from you, from somebody else, a depositor, and they'll have to pay the interest, okay? So the interest is the product. That's what you got to see. We had a bunch of symposia with the Rabobank, and the first gentleman who came there said, okay, the business of the bank is collecting interest, okay? We charge a lot of interest to the people we give money to, and we charge a little interest to the people we borrow money from, and the difference is our spread, and that's our profit, right? Depending on the flow. How is that different from Shell, who's going, all right, our business is oil. We go to one guy in Saudi Arabia, we buy the oil from, and we sell it to another person, and that price difference, that's our profit. I'm just forgetting the fact that they had to do some refinery now for the moment. I mean, the bank also has to do quite a bit of other things in the middle. Ultimately, the business, the product they sell is interest, and the fact that they have to hold the capital is a necessary evil for this. Ultimately, the product, the reason the land is there is to yield the crop, and the holding and the defending and the maintaining of the land is the necessary evil that goes along with it. It's the capital you need, okay? So you see that our capital dimension, Q0, can now be replaced by the balance of the principal. So you start with a 500,000 euro loan, maybe there, and then you start paying off, and then, maybe you end at a certain point right here, right? Huh? At some point, Q0, after you've paid off this part of the loan. But while you do that, you're also paying some interest. So you started at 0 interest, and then you went up, maybe you took this path, and ultimately you ended up here, all right? At this point, you're still paying back your loan, or the way I drew it, it's almost like he upped his mortgage, he asked for an additional amount of the money to borrow, and he's still paying his interest here, okay? So this is no different than investing in further goods or divesting when you sell your equipment, okay? Huh? And storing or unstoring, selling, your products, all right? That's what you have to see. So if you're cool with that, I can proceed. Because now, you see, these are not units of capital goods and others, they're all measured in euros or dollars, I just put here, all right? Huh? So it's a little bit unclear what now the difference is, but we still have to keep it separate, all right? And then you can look at the repayments per year, and you can look at this tangent space, and you will just get the receipts, what it is you're getting per unit of time in terms of repayments and in terms of interest payments, okay? So all I did here was translate a regular production business, like a farm, age-old things, to a bank statement. It's just that the flows are all money flows, all right? Okay? And I can play the same trick. I can say, well, the amount of interest, if I divide that by the amount of the principal still outstanding, now, I'll get the interest rates, right? Because that's how much I'm paying over that amount in interest as a percentage. So that will be in percent per year all of a sudden, right? So all the units start canceling because we'll get interest dollars divided by capital dollars. Well, they're both dollars, so it becomes a percentage. And this is how we're used to seeing an interest rate mentioned in percent per year, so money percent per year, right? I mean, percent is not really a unit, I just throw it in, all right? So really, I should be ushered out of the room, except I'm the one doing the ushering, so I'm not going out of the room. And the same thing goes now by the repayment rate. That's a little bit more obvious because that was the other thing. So this is always a percent per year, all right? And this is called the repayment rate. Okay, this is just the names for that. So that's the negative of the capital accumulation rate. That's how much it's going down. There's a minus sign that I'm being very liberal with here, okay, just to get the concepts across. So this is just some terminology. If you look it up, you'll see that this is the case. And then, you can plot this thing in interest rates. So this is the total amount of interest. This is the period total interest, or accumulated interest, better. As a percent, and there's sometimes you just leave the principal, then they will call this the current balance, I believe. But you can also look at the growth, you start up with a notional amount, say 100,000, and then you just look how it grows, or, we're so much above par, and then they will say this thing is, if this is positive, a number bigger than, this will be above par or below par, that kind of terminology, all right? As a percentage above par. So your par value, say with a bond, is 100,000, but it's 110,000 now, so you're 10% above par, okay? All right? This is just some terminology. So you see, again, we find ourselves, for some reason, oh, here we go. So we find ourselves in a similar situation as we were before. So we have a two-dimensional base space for our analytical mechanics, symplectic theory. We have a tangent space, that's demand for principal, that's sometimes called the demand for financing, right? And there's the demand for interest, right? So that's usually called what? They're searching for a return on your money, right? So investors will do that. They'll start looking. Now they are willing to take a lot of risk. The risk is not perceived, but there's as an investor, you're looking for this, and as somebody who needs investment, you're demanding the financing, the money itself, and you're willing to pay this. All right. And the whole thing now, your state space is again four-dimensional. All right, this is a nice vector space. This need not be a vector space, especially with these angle variables. And now we have an interesting point of view, because what do the expenditures now do? This thing is already in dollars, right? And this thing too. This is the total amount of principal outstanding, the current balance, and this is the total amount of interest payments that are made. So what's this price that we have to multiply this with, right? That's somewhat an enigma. Now, if you see, here is a statement of the Bank of America, and I put this in here to show you. They do banks. They do their books a little different than other institutions, and you see they have here. This is their chart of accounts. So here are all these different accounts, and but they have the two dimensions now separated in these two columns, right? So this is the Q0 dimension, and this is the Q1 dimension, right? So here, for every account, they keep track of what the balance is, the capital that they have outstanding. So they have lots of Q0s here, and then for each one, they will have, now the interest that they received on that, okay? So these are their earning assets. So they have, this is the amount of loans and leases. I guess those are the mortgages to consumers. And this is the total they have outstanding. So that's their running balance. So this will be their total P naught times Q, let's keep it easy. And this is the total interest they received on that, which is this Q1, all right? Now, they have some other stuff they divided up, and there's different products they get and where they can get their interest from, all right? Now you ask yourself, well, is it? I mean, what's the problem here? Where did the price go, right? Well, it went nowhere here. And that's precisely the problem. So what they assume here is that the price of money is 1 here. And then everything works out. This is, of course, the tautological one for the expenditures. And you say, all right, the principal, every dollar of principal, I'm going to value at $1 per dollar, and I'll just get the same number as the principal here. So this would be equal to right? This is just 1. You take it out of the integral, and there you have it. So the price of money is 1. But is it? The problem is that it really isn't, because there is something called risk. So if you have an amount of money you have outstanding in a loan, you can't just assume you're going to get it. What if that guy goes into default? You won't get your money, right? It's like betting a euro on a flip of a coin. You can't just assume you're always going to win. Sometimes you're going to lose. So you may only, on the average, consider this thing worth 50 cents rather than a euro. All right? Now, of course, if you get a euro and a coin will only come up heads, I mean, there's a coin with 2 heads on either side, then sure, you can assume that the value of this is 1. So there's no risk associated with these dollars you're getting in here. These are dollars. This is Bank of America, right? Then you can play this trick, and in this general ledger or in this balance sheet, you can just plug in these two things. But when there is risk, you cannot do that, and you'll have to multiply this by some sort of price that adjusts it for the risk. All right? And that's the topic of this lecture, how we can do that with, how we can find this price with economic engineering method, and how the Lagrangian approach does it, okay? So the first topic is actually getting this all in something that we can do something with. And now the second part is to figure out how we can treat risk as the price of the various types of money. You can see there's going to be 2 types of risk. There is the risk on the principal, right? And there's the risk on the interest. So there are 2 types: the risk that you will never be repaid, and the risk that you may not receive all of the interest. All right? And if you add them together, then that will be the total risk, adjusted return. All right? Okay? So before we move on to that, for some reason it goes into some mode here. Yeah, who knows? Before we go on with that, so yeah, so I'll do this after the break. I want to make this a little bit more concrete, how this whole thing will work out, all right, with a real world example. This was all general considerations, and I just want to like hammer home these concepts in preparation for what we're going to do. And here in the Netherlands, we have these things called annuity mortgages. Now, the reason we have these things and we keep track of them is because the Dutch tax code allows you to deduct the interest on a mortgage payment. You won't be able to deduct the principal, but you will be allowed to deduct the interest. There's some other countries that do that, and they will have similar systems, but there are many countries where you can't, like Germany, I believe you can't, and Belgium, I don't think you can, right? Well, Emil is too young to have a home, so he may not know that, but then it becomes less relevant. But the one nice thing about the Dutch situation is the separation of interest and repayment you have to keep track of it, otherwise you won't know what to deduct, okay? And this is done by using these annuity mortgages, and there are several, but here I've shown you from also from the internet, the two that are most popular. All right, so the most popular actually is this one, where you keep this is the monthly payment here, and you keep that some fixed number. And then in the beginning, you will only pay interest, you know, and a little bit of repayment. But as you make a repayment, the amount of the interest will become a little bit less, all right? So you're starting here, over there, and as you make an interest payment, so there's a big one here, but you make a very small repayment, right? But because you're here, what they do is they keep this theta vector constant. So theta, well, v theta is v1 divided by q0, remember? So this thing is held to a constant, which is the interest rate you have to pay on the remaining balance, okay? I don't know what this is, 2.5% or something, right? Huh? Per year, right? I'm just making that up, but it's not so far off, all right? Okay? So as your balance gets smaller, this actual payment is going to be smaller. You see, this thing will be the same. This gets smaller, so this has got to be smaller too, all right? To get this ratio to be equal. And then you'll have a little bit more left over to make a payment, all right? Huh? So you'll be, this thing will say, so if you look at the tangent space, you will see first you do this one, then this one. If you, I think I'm doing this the wrong way around, huh? These vectors.
So the Q0 is the repayment axis and the Q1 is the
Right,
axis, right?
right. This is the repayment axis, so this is what they call the current balance. So this is the print of the principal, right? And this is the accumulated interest, huh? This thing is not ideal, huh?
No.
Huh? And this is the interest rate, huh? And what they'll do is they'll set this equal to a constant, okay? Then they set every monthly payment also equal to a constant, and then you can calculate what the mix of principal and so this will be this one, then this will be that one, you know, so I think, and in the end, all you do is is a repayment, a big repayment, and then when you reach zero, the whole thing becomes degenerate and it stops, right? So it's sort of a, I don't think it's a circle, you know, but it looks a little bit like a circle. It can't be a circle, right? Huh? But some kind of bulbous movement like that, where you have your tangent vector is exactly the two components here. So the dark green, this is the dark green, and this is the light green. Huh? All right? So interestingly, this picture here tells you how to read off the tangent vector. Huh? So this part here is the Q1 dot. So that's, oh, come on. So this is V1. This is V2, right? Huh? Okay. So it allows you to read off. Sorry. This is indeed V1. I shouldn't have. This is V1, but this is V0, right? Huh? So this thing is, this is the V0 here, and this is V1. So you can see how this vector is kind of sloping like that. Does everybody see that? I'm doing a terrible job, but you know now, huh? But you get it, right? It's true what I'm saying, except I'm struggling with the software. And here, of course, is different, right? So here you will see that V0 is a constant. Huh? Interest rate is also a constant, right? So this thing is just decreasing. Yeah, it's just the amount of interest will just be decreasing. So you'll just go a constant repayment rate and ever decreasing. Yeah, also sort of a curve like that, right? Huh? Well, except this thing will, yeah.
That will
Yeah,
be,
but
more convex.
this one will be more convex.
Yeah. Well, if you look like this,
Yeah,
that's
more
okay.
more like that, right? Huh? Right? Huh? Yeah. So this is this one. Huh? Somebody could plot these things. Anyway, this is the equation of motion, right? This is the solution to the equation of motion here. What you have, here's the path. This thing will tell you the time, right? So here's the tick marks, and this graph will tell you what this tangent vector is, right? The velocity vector. That's the point, okay? So this is a contract that you get. You go to the bank, you get this contract. It's going to stipulate everything, all right? It will stipulate how you go, what the time parameter is, and they will calculate these flows and everything, right? Huh? Okay. And this one stipulates a different path. You can make them up as you go along. All right? So this is just to say, listen, we did this whole thing and it all looks abstract. But if you just look at a simple annuity, I mean, from the perspective of phase space, these are just specifications of the actual motion, right? And what you need to do is to go home and calculate what the Lagrangian is on this thing, okay, in 2 dimensions. Then you will integrate that, you know, boy, I can't go too high either, right? You integrate that over that period, and then, oh, damn. And then you have to minimize this action. That's the decision making involved with choosing which of these repayment schedules you want, what the period is, the 30 or the 20 years, etc. Right? Huh? Quite a job. Huh? So sometimes people come and they think I know anything about money just because I was on Wall Street, and it doesn't mean you know anything. And then they ask me which of these two. I have no idea. You know, this is problem. It's really important to think about. It's hard to. We haven't even done this Lagrangian yet, but that's the problem that you face when the bank is doing this business with you. All right? Huh? Okay. Now you can partially specify these things. Sometimes people say, well, I'm only going to, I don't know whether it's 30 years, we can maybe do this in 10 years, right? So you don't give the time interval. You don't say how it goes with the time. You just give me this, this trajectory, all right? Then what do? Well, then you can't calculate these tangent vectors, of course, because you need a time parameterization, right? So well, you'll just have a constraint. And these have names. They're called holonomic constraints in this case. And then you can switch to different variables, these angle variables, and then you can use that as a single angle variable as a way of some yield variable, overall repayment percentage variable, right? There's some varying interest rate or something that says how both of them are traded off. And then you can reparameterize the problem as a one-dimensional Lagrangian problem, all right? That's already easier. Then you first separate the choice of the duration of the loan here as well as 30 years from the actual choosing of which one you want. Do you want one of those linear annuities or regular annuities, okay? So what they do is they throw everything at you, but as an economic engineer, you can like separate them in different steps. First go to a holonomic submanifold and then sort it out, okay? Now what I want to do now is take a break, but first reiterate where we've come. We've just taken banking, and most of banking are mortgages or other loans. I've taken here a mortgage. I've showed you what is the minimum space if you have one form of capital and one form of interest that you got to work in. The minimum base space is two-dimensional because you got to keep track on the balance of the amount of interest that you've received and the amount of principal you have left over, okay? But you also need the tangent space. You also got to know at every point how much he's going to pay in the future, the next period, what the next payment is, okay? There's another two-dimensional space, and that's this space that you get on there, okay? And then you have to specify what path you go in that space. You can do that by first setting a sort of constraint that will say whether you do a linear or a regular annuity or this or that, you know. Huh? And then do the time parameterization where you say what the term of the rate is. And then you'll have to also specify which of these variables you hold constant. So here, the interest rate is held constant. You have floating rate ones. Then this thing can change over time too. Okay, it's a little more complicated, but it will all work out. Okay? The thing I want to convince you of, this is the right setting to analyze these things in. Now, the thing I'm going to try to show you is how we would proceed then to do that. Remember, this is just state space, just a bunch of velocities and positions. We don't have any momentum yet, so we can't do any Newtonian mechanics. Now we have to add the notion of momentum. We have to go into the fiber, you know, and attach a price to all of these things. To every demand, there's going to be a new price. Once we've done that, we'll know what the price of interest receipts is and what the price of repayments for capital is, you know, and they're going to be both measured in some percentage, you know, and they will both measure a degree of risk, and then we'll see how that idea hangs together with usual expected utility theory, and we'll be able to put a, you know, in phase space, we'll be able to value these things, okay? So that's for after the break. So I'll see you in about 10 minutes, okay? Now, what do we do here? Can we put this on pause or just, huh? Hey, Pieter, huh? Welkom.
Heel interessant en ik moet jammer nog nu afhaken, maar ja, ik raak aangehaakt nu, in ieder geval, gelukkig.
Ja.
En ik kan je nog ik kan ook wat grafieken laten zien.
Ja,
ik kan hier meteen op ingaan. Dus,
ja.
maar goed, dat zal ik je wel sturen.
Goed, en
Ja.
dan kijk dan even naar die tweede helft. Daar probeer ik dan die kansen in te brengen en dat soort dingen. Oké?
Ja.
Huh? Ja,
Yes.
super.
Oké.
Dank je dat je er was. Huh?
Spreek je vrijdag.
Ja.
Ciao.